Robschild, thanks for tuning in. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do. And so we begin. Today is Tuesday, August 27th, 2024. Today's episode, we're going to start talking about the NFL, taking advantage of Mr. Market. Headline from CNBC.com, NFL owners vote in favor of private equity investment. Select firms commit $12 billion. They're allowed to invest up to a 10% of a team stake. When companies are offering enormous amounts of IPOs, when they're offering secondary shares, and when they are increasing private equity investment, that's one of the telltale signs of an expensive market. For better or for worse, companies are smart by taking advantage of an expensive market. When people are willing to pay any price for equities that aren't necessarily worth what the market says they're worth, why not sell shares out there? Benjamin Graham talks about this in his books, and it's just one of those things that happens when markets are overvalued, as they are today. This is the S&P 500. The PE ratio, what is the cost of earning $1 per year of the S&P 500? It's not exactly the S&P 500, but going back far enough, there are companies that might represent what the S&P 500 might have been as far back as 1880. And as you can see, as I've pointed out in shows before, I just feel like it's important to bring this up again because I haven't talked about it in a while, and it's insanely important to understand. This chart going back to 1880, you can see it used to be normal to own $10 worth of a company that would earn $1 a year. And sometimes we would get expensive. We would get up to around 25. Sometimes we'd get really cheap. 1917 looks like we were down to 6, or briefly in the 1950s again down to 6. Again, this is $6 worth of a company earning $1. So that's like cheap. That's when equities are cheap. They're expensive when they get up into this range in the 20s. Now remember, when a PE ratio is 20, it's the equivalent of a company earning a 5% yield on the value of the company. And so if you have bonds that are offering a 5% yield and you have equities that are at a PE ratio of 20, bonds are a guaranteed payment. And although those payments can't grow over time, the equation doesn't quite make sense. Now, since 2000, as yields have been dropping, people have been saying, "Oh, things are different now. S&P 500 will be worth a PE ratio of, from 15 to 20 forever," and that's how it's been priced now, between 15 and 20. But this is also during a period where bond yield rates have been very low. And so when you have extremely low rates of return on guaranteed payments, then it makes sense for the PE ratio of stocks to actually be higher. That actually does make sense. But right now, with the Fed funds rate around 5% and the 30-year bond yield going all the way out to the 30-year bond yield yielding for over 4% right now, a current PE ratio of 29.39 doesn't make a whole lot of sense. Now, notably, when the PE ratio goes way up, it's not necessarily always because the price of the stocks are going up. A lot of those spikes that you see on that chart are not stocks all of a sudden getting a lot more value. A lot of those are the earnings are shrinking. And so when the earnings shrink, when they're smaller, when companies are earning a smaller amount of money, it makes that PE ratio jump up. But that's not what's happening today. Today's 29.39 is not because the earnings of companies have dropped dramatically as they've done in the past for many of these spikes. Instead, the price has just gotten so out of control, it's gotten so high that we're already at over 29 PE ratio, all while bond yields are much higher than they've been in a long time, which makes this number not make sense. It's pretty clear that we're headed into a slowdown. It's either a soft landing or a hard landing. There's not really any such thing as a no landing. And so when we get that landing of some kind, we will get earnings contraction along with unemployment going up. And when the earnings contraction, this PE ratio is set to spike much, much higher as earnings contracting rather, will very likely outpace the drop in the price, sending this PE ratio even higher. There are lots of times in history where the S&P 500 costs $6, $6, $7, $8 per dollar of earnings. It happens often. That's a great time to be purchasing stocks when stocks are very cheap. Even more recent history, in 2011, we had the S&P 500 drop to a P/E ratio of under 14, 2006 at 16, 2018 we dropped below 20. These were relatively cheap compared to the 29 that we have today. For if earnings don't contract, if earnings stay the same and the stock price were to normalize back to 20, that would be a 30% decline in the price of the S&P 500. But the bigger last point I'm just trying to make is that, the time to buy stocks when they're cheap is when the PE ratio is low, not when it's high. And it's clearly high, suggesting that the market is clearly overvalued right now. I wanted to do a quick revision of that because of its importance, because of headlines like this, NFL, these kinds of things, as well as the fact that not much is going on in markets, especially today. Gareth Soloway on his show said that today's volume specifically is the lightest volume he's seen in years, which means that, when you look at the price of what's going on, it's not really worth looking at. You have to take such a big grain of salt with the movement today that it's probably not even worth even looking at. But we will anyway. I have a few things to talk about. Very notably, the market's obviously waiting for the Nvidia earnings. As I've been talking about in many shows, the value of this one company to get back down to what's considered anywhere near a normal valuation, it would have to drop by about 66% in value. Its PE ratio being around 72 at the moment. Unless its earnings are just blow everybody out of the water, this could be a major headwind for the stock market, and actually be a major catalyst maybe to continue what I see as the current downtrend in stock markets. Notably as well, Thursday, the quarter 2 GDP second revision is coming out. The current GDP number was positive 2.8%. As I mentioned in yesterday's show, if you have revisions that show it lower, that is another sign of a recession. Also, we have Friday PCE data, and next week we have some much more important data coming out Wednesday. Job openings, the last rate of this was 8.18 million. We'll see what's going on with that. Is this going to increase a lot, decrease a lot? I guess we'll see. And the biggest, most important number that I rely on as far as macro goes, as far as market analysis, is the unemployment rate. The last reading of this was 4.3%, which recently triggered the SOM rule, indicating that the recession has already started. Daily reminders, the other daily reminder being 2-year, 10-year Treasury yield curve is inverted, and it's been inverted for 2 years and counting, about almost 2 months now. Looking at the S&P 500, the head and shoulders pattern that I had drawn out is still in play. We did not break above the highest high in the S&P 500, nor in the Qs. This is more obviously turning over here. I do kind of expect this head and shoulders to play out. It's playing out so far. I don't see anything stopping it. If anything, this NVIDIA earnings coming out, I think, could accelerate it. I really don't. I mean, even if it makes an enormous amount of money, like Benjamin Graham says, all it takes is a slowdown in the growth of earnings in order for a company with a huge PE ratio to, suddenly shrink, which is what I'm fully expecting to have happen. SMH, same thing, the semiconductors ETF itself. Very clear. Today's little green candle just added another little notch in this downtrend towards the neckline of this epic head and shoulders pattern that I think this is it. I think this is the head and shoulders that will break the market here. But remember, I'm just a guy with the crystal ball. Again, with super light volume today, pretty meaningless, and I don't have a whole lot to say other than repeating what I've already been saying. The credit spreads are crazily tight right now. Junk bonds are just surprisingly expensive. People are paying too much money for the amount of yield they're getting in high yield corporate bonds and junk bonds, in my strong estimation. VIX futures curve, again, October, still highly elevated. It's inverted from October through the December contract. A lot of people, including myself, have options contracts in October, or that expire in October rather, trying to protect from volatility, or make money from the volatility, however you want to see it. Fear and Greed Index still in neutral zone. Again, the volume being so light here, it's like there's really nothing to see today. TLT, if as far as patterns go, we were in this very clearly in this channel. We clearly broke out of it, so this is now a defunct pattern, I guess we could call it. It's a little less clear in the 10-year note yield, as we're kind of verging on that line, but on the 30-year Treasury yield, it's a little more clear that it's that we at least want to go sideways here. We're kind of confused. We don't really know what to do here. The market really is just sitting on its hands, waiting for NVIDIA earnings. This could really be explosive. Thursday, Q2 GDP, this could actually be explosive too, especially if it's like a negative 0.2 revision. So if it drops from 2.8 to 2.6, that could actually be explosive for markets. And then Friday PCE data, and again, like, the biggest piece I'm waiting for isn't until next week's Friday, that big unemployment rate number. If it's significantly lower than 4.3% for whatever reason, the markets will take that. That would be problematic on the side of inflation. Okay, so bonds will drop in price. Stocks should continue higher, and it's like, in one way it's sort of a good thing temporarily, but if that were to happen, but I can't see that happening here with the SOM rule triggered, with the Fed willing to cut in the first place. It's pretty clear to me in my crystal ball that they see enough weakness here. They already know these numbers. They, or at least, have enough data to guesstimate this number, and seeing as though they're saying, yeah, we're cutting in September, this unemployment rate is probably, in my opinion, a lot higher than what anyone expects. I say that with a little hesitation, just because it's true. Like the inflationists have a good point. The people think that we are headed into a soft landing sort of have a good point. Everything seems peachy. Unemployment rate by itself, it seems fine right now. We don't see any very blatant issues. We're not seeing, people rioting in the streets because they can't find work. Bankruptcies just going crazy. Junk bonds losing all of their value. We don't have that yet. All indications say that we're at that point in this cycle. Another piece of this that I just came across yesterday was, I think it's the YouTube channel called Figuring Out Money. He's amazing. He was talking about the different sectors that perform differently in different parts of the business cycle, and how, we're there. It's clear as day, if you're really putting all the pieces together. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.